Welcome back to the channel, helping you earn more, spend less, and invest the difference. Now, we all know that the rich have an army of lawyers and accountants to be able to greatly reduce the amount of taxes that they owe. The game is rigged because they all know the rules, they have all the cheat codes, and you don't. But today we're going to talk about a fantastic way to legally avoid some of those nasty taxes. And the best part is, literally anyone can take advantage of this. Now, as with most tax strategies, this particular method will work better for some people than for others. For some people, it's going to be a little clunky and awkward, and for others, the strategy is straight up a money-making machine. It just depends on your particular situation. Now, I should legally say that I'm not an accountant or CPA. I'm just a guy on the internet who loves saving money. So, as always, consult your own tax professionals. All right, so the method we're going to talk about today is known as the Augusta Rule. This rule came about because every year there's a massive golf tournament hosted in the city of Augusta, Georgia. And during this golf tournament, people would fly from all over the world to watch the tournament. So naturally, the residents of the city recognized an opportunity to make some money by renting out their homes to all of these visitors. But they didn't want to be classified as a full-fledged residential real estate business. They just wanted to casually rent out their house for a week or two during this golf tournament. And thus, they petitioned the government, and eventually the Augusta Rule came into place. Essentially, the rule states that you can rent your personal dwelling unit out for less than 15 days, and you don't have to pay any taxes on the money that you earn for renting out your house. That's right, you can effectively earn up to 14 days worth of rent from your house completely tax-free. And the best part is, it's not a complicated process. You literally just don't report the income when it comes time to file your taxes. It's that simple. So let's talk about a few ways that people can use this piece of tax code to their advantage. The first method is admittedly a little bit clunky and less than ideal, but it can work for literally anyone. And the second method that we'll discuss is straight up gangster, but it's not going to apply to 100% of you viewers out there. At some point, you're going to go on vacation of some sort. Maybe you travel back home for the holidays or take a family trip to Disneyland for a week or two. The point being is, at some point, you are going to be away from your house, and while you're gone, why not list your house on websites like Airbnb? Many geographic locations can earn between $100 to $300 per night for listing their home on Airbnb. So if you rented your place out while you yourself are on vacation, you might earn somewhere between $1,400 to $4,200 for renting the place out for 2 weeks. And that income is completely tax-free. But remember, this rule came about because of special golf tournaments coming to the area. So what if your city is hosting a big event? Maybe your city is hosting the Super Bowl, a golf tournament, or some big concert, etc. During these specific times of the year, your average nightly income might jump from the normal $100 to $300 per night up to $500 a night or $1,000 a night or more, depending on your location. If you have a nice house close to the stadium, then it's entirely possible that you could rent that house out during the Super Bowl for tens of thousands of dollars for the week, and that income would be completely tax-free. Now, I get it. Some people don't want to Airbnb their primary house while they're away on vacation. I get it. But this second method is straight up free money. But the catch is, you do have to own a business. So with this method, instead of renting your house out to a bunch of strangers on Airbnb, why don't you rent your house to your business for 2 weeks? That's right, your business that you own can rent your own house from you for up to 2 weeks. So let's just say that your business rents the house for $300 a night for 2 weeks for $4,200 total. Now that $4,200 is not considered income because of the Augusta Rule, so you would not need to report that on your personal taxes. Now you might be saying, but that doesn't do me any good because I'm $4,200 richer, but my business is $4,200 poorer. So nothing really happened. But The key to all of this is now your business can claim a $4,200 tax deduction. You don't have to claim the income, but you still get to claim the business expense as a $4,200 tax write-off. Now, there are a couple of key points to this method, and the first is that you have to own a legitimate business that is not taxed by the IRS as a pass-through entity. So your business cannot be a sole proprietorship or a single member LLC. Instead, you would need to be operating your business either as a corporation like a C Corp or an S Corp, or you could have a multi-member LLC or a partnership or something like that. And the other important thing to note is that your business needs a legitimate reason to rent out the house. So, for example, my family has a family business that we're all partners in. So instead of all my siblings traveling back to see mom and dad for Christmas, like normal people do, instead we have our business rent mom and dad's house for 2 weeks, and our business hosts a corporate retreat at mom and dad's place. And this corporate retreat just happens to be the 2 weeks of Christmas. If mom and dad want to come and visit me, they don't just come and visit. Instead, our business schedules a shareholder meeting, and the business rents my house for a week or two. Each time we do this, we don't report the personal income, but our business gets a tax break each and every time. So if you have a family business that can be 2 weeks at your place, 2 weeks at mom and dad's place, 2 weeks at your sister's place, etc., it can very easily start to add up to very large tax deductions for your business. Now, obviously, your business has to actually conduct business during these 2 weeks to stay within the tax law. Now, another way you can do this is I own some rental properties in another state, and so I recently needed to go back and check up on these units. Now, normally you would just go and rent a hotel or something like that as a lodging expense, and that would be a legitimate business expense. But I used to live in this city, so I have a bunch of friends that still live there. So the natural thing to do is just to simply stay with a friend for free. But instead of just staying with my friend for free, I paid him. I rented his house for a week, and we both stayed there. I still got my business deduction, and he got some extra tax-free income. Now, you might be saying, but under this scenario, I still lose out because instead of getting free lodging with my friend, now I'm paying for it just to get a tax deduction that I otherwise would have gotten had I stayed at a hotel. So you still end up costing me money because that deduction is never going to save you as much money as simply not having spent that money in the first place. And that's true. But my friend was super grateful for this extra free income. And in return, he was generous enough to buy me tickets to a concert and a variety of other entertainment events that we went to while I was in town. Under the Tax Cut Jobs Act signed into law a few years ago, I can no longer write off entertainment expenses as business expenses. But if my friend wants to treat me to a free show, then who am I to argue? Now, a couple of quick tips. It must be less than 15 days total for the entire year. Now, these days do not need to be consecutive, but it must be less than 15 days total, or else this rule goes completely out the window. So, for example, if hypothetically you rented your house out for 15 days, you would get absolutely no tax benefit. You would not get 14 days of tax-free income and then just pay taxes on the one remaining day. It's all or nothing, so keep it at 14 days or less. Second off, it doesn't matter if you own your own home or rent it. If you're renting and your lease with the landlord says you can sublet the unit, then you could re-rent the place out for up to 14 days tax-free. And lastly, this rule applies to personal dwelling units. So it could be your primary home, it could be a secondary home that you own, like a summer house out somewhere. It could be an RV that you rent out for 2 weeks. It could be a boat with a sleeping cabin that you rent out, etc. Now, as I said, this video is for entertainment purposes only. Always consult your own tax professionals before engaging in unfamiliar activities. But with your CPA's consent, the Augusta Rule can be a fantastic way to either earn some completely tax-free income or legally shift money around from your business to yourself and in the process create a fantastic tax deduction for your business. If you enjoyed this video, consider subscribing for more money tips. And as always, I'll see you all again next time. Thanks.